When banks fail, the world suffers not only the shock, but also the change that follows. Economies shift, structures crumble, and in the shadows, new orders are penned into existence. These events do not make headlines at first, but, in retrospect, are the defining moments that forever alter the course of the global economy. They are not mere financial mishaps, they are turning points in history. This is the Economic Archive, and today we explore how some of the most pivotal moments in the global economy came to pass, not through innovation, but through collapse. It starts in the 1600s with the Bank of Amsterdam, which was considered the most trustworthy financial body in Europe. What was not apparent was the increasing secrecy of its lending operations and behind-the-scenes politics. This trust was lost incrementally, but don't say lost, the effects were sudden. It was one of the first instances in modern history that showed how, without scandal or war, simple trust could sustain a banking system or destroy it. Then came the 1700s, a very tumultuous period. In 1720, the South Sea Bubble and the Mississippi Company collapsed in Britain and France, respectively, left two of the most powerful economies in Europe on their knees almost at the same time. What drove these events? Speculation, hubris, and perilous politics between governments and unaccountable corporations. Investors poured in, lured by the feeling of a once-in-a-generation opportunity. However, the illusion of success turned to disappointment, and fortunes were lost as many learned the hard way that government proximity is no immunity. This was not a swift recovery, but the emergence of concepts for basic investor protection, still fragile and in their infancy stages, but a step in the right direction. But let's go back to 1873, when the collapse of one company, J. Cook & Company in the United States, triggered the Long Depression. It lasted for more than 20 years, its effects reverberating across Europe and North America. It was triggered by an overly aggressive expansion into railroads, a rapidly growing industry at the time. But its collapse led to the destruction of investor confidence, credit, and millions of dollars worth of wealth. This downturn was different in terms of its longevity. It was no mere dip. It was a drag. As a result, countries started thinking about how their financial systems were structured. They changed their monetary systems, tending towards gold to stabilize the volatility of silver in a bid to correct systems that had gotten out of kilter. But nothing seared itself into the world's consciousness like 1929. When America's stock market crashed, the shockwaves extended far beyond the walls of Wall Street. The crash revealed a financial system that was fraught with peril and woefully unprepared for a loss of confidence. Banks closed, savings were lost, businesses faltered, and out of the chaos came the Great Depression, a breakdown. Not just an economic downturn, but a social one. Governments could no longer look the other way. In the U.S., new policies reshaped the nation's financial skeleton. Deposit insurance through the FDIC offered a safety net that had never existed before. Laws like the Glass-Steagall Act drew sharp lines between traditional banking and market speculation, and the Federal Reserve adopted a more proactive role in overseeing not just money supply, but economic stability itself. Across the Atlantic and beyond, similar changes echoed. Then, in 1944, leaders from around the globe gathered in Bretton Woods to imagine a more stable post-war system. They placed the US dollar at the center, tied it to gold, and built institutions like the International Monetary Fund and the World Bank to stabilize nations in distress. It worked for a while, but by 1971, the weight of rising US debt and international imbalances forced a major shift. President Nixon's decision to break the dollar's link to gold ended the Bretton Woods Agreement and launched the world into an era of floating exchange rates. Now, currencies moved with markets, not minerals. It gave governments more monetary flexibility, but also introduced new unpredictability. Central banks became primary economic navigators, managing interest rates through storms of inflation and recession. Fast forward to 1997, and a familiar storm returned, this time in Asia. What started as a small slide in Thailand's currency quickly evolved into a full-blown regional crisis. Banking systems collapsed in South Korea, Indonesia, and Malaysia. Capital fled in record time. The International Monetary Fund stepped in with loans, but they came with conditions. Economic reforms, reduced government spending, and deep structural overhauls. These countries recovered slowly and learned a lesson that still rings true: global markets reward growth, but punish fragility. Then came 2008, What looked like a booming American housing market turned into a global economic trap. Risky mortgage lending, complex derivatives, and under-regulated financial products created a ticking time bomb. The collapse of Lehman Brothers was the detonation. Financial markets froze. Banks stopped lending, and for a moment, the system nearly stopped functioning. In response, world governments did what had once been unthinkable. Central banks slashed interest rates to near zero. They bought up toxic assets. They stabilized everything from national banks to local home loans. Reforms came too, particularly in the United States. Dodd-Frank legislation, stress testing for banks, and capital reserve rules to limit unchecked risk. Globally, the Basel III framework emerged, reshaping how financial institutions manage their liquidity and exposure. But even after the dust settled, one question remained. Had the system been fixed or merely patched? That question got an early answer in 2020, when the COVID-19 pandemic arrived. While not financial in nature, the crisis threatened banks just the same. Lockdown industries meant missed payments. Central banks jumped in with trillions in stimulus, purchasing bonds, supporting markets, and ensuring banks remained solvent. It worked, but not without consequences. Inflation returned swiftly. Asset bubbles expanded. Speculation surged, and behind the scenes, old vulnerabilities lingered. In 2023, those vulnerabilities reappeared. Silicon Valley Bank, one of the most admired technology lenders, failed practically overnight due to poor risk management and a depositor base that moved faster than traditional safeguards could react. The response was immediate, but the discomfort was familiar. If risk could sneak past post-2008 reforms, how secure was the system really? What's clear is this. Every financial collapse in history came with its own version of the same warning. Trust is the real currency of banking, and once it disappears, so does stability. Banks exist because people believe they're safe. That belief is reinforced by regulation, policy, and precedent. But history tells us belief alone doesn't protect systems. Policy evolves because trust once broke. Today's banking safety nets, from deposit insurance to central bank backstops, exist because prior generations learned the cost of crisis the hard way. The fall of Amsterdam built the idea of reserves. The destruction of speculative bubbles in Europe birthed oversight. The Great Depression made deposit protection mainstream. The 2008 collapse redefined global financial stability laws, and the pandemic showed that financial survival is as much about response speed as planning. At the Economic Archive, we believe the clearest view of the future often lies behind us. These aren't just historical footnotes, they are blueprints. Every collapse created new institutions, forced political will, and built the invisible frameworks that now define your savings account, your mortgage, and your financial confidence. Understanding how the system was built, often on the ashes of what failed, isn't about fear, it's about seeing clearly. Because the next crisis won't come with a warning label, but guaranteed, it will rewrite the rules again. If this story gave you a deeper understanding of where our modern banking system comes from, support the Economic Archive by liking this video, subscribing to the channel, and sharing it with someone who still thinks financial systems are too big to fail. And in the comments, let us know. Is today's banking world safer or just better at hiding the cracks?